I had a rough morning, and I get very tired of dealing with the incompetence of unethical advisors and some of the planning stuff that I have seen to the absolute detriment of clients. So I think we're going to talk today about just different examples of things that we have seen that we just really dislike, either about the industry or specific, kind of techniques. So I ran into a situation today. Well, I mean, I've
Ongoing.
ran into this a lot, but one of the examples that came up for me was we dealt with a client who had no RSPs, no TFSA, no savings. He had a loan due to shareholder of $600,000 on his dental practice, and the advisor recommended and sold him a $50,000 a year par policy as a corporate asset transfer to pull money tax efficiently out of his corporation. And this guy went through COVID. His business, was affected a little bit. His rent went way up, and now he can't even afford the premiums on the policy. And so what we ended up having to do was cancel the policy. The guy walked away from $100,000, probably $150,000, and he's got absolutely nothing to show for it. And I went to the old advisor and I said, "Why did you recommend this? It makes absolutely no sense to try to pull money tax-free out of a corporation when he could already pull $600,000 a year or $600,000 total out of that corp to begin with." And he's got no RSPs, he's got no IPP, no TFSA, no anything, and that was the recommendation. And so it just absolutely irks me when I run into those types of scenarios.
Yeah, and for good reason. And to your point, like before we start really talking about all the different things we see constantly, because this is just one of a billion stories that could be told. But like obviously it affects the clients. And that's like it affects everyone because it also affects all the advisors out there. And we're good ones. But we're not the only good ones. There's lots of good people in the industry, and all the ones who actually know what they're doing, who actually are educated on finance, who are good at their jobs and who care about their clients. It's hard to distinguish, right, between those who are just really good salespeople and don't give a crap about anything other than just making a buck in the short term versus the good ones. And so then it's hard to kind of separate yourself and stand out, especially when the other side is just lying, right? So it's like you're trying to fight lies. And ultimately what I'm trying to get at is just the fact it makes it very hard to get people's trust and for people to put their trust in the people that are actually doing a good job. Because yeah, like just people in the industry have done such crappy things for such a long time that
It really
how do you
tarnishes the
know?
reputation of advisors in general.
Mhm.
And the issue that I have is a lot of the time it's the people who are really active on, like I dealt with this one client. The guy was making, $60,000 a year, farmer, rancher, didn't make a ton of money, but the guy was spending $15,000 a year on a permanent insurance policy. And he went to a guy because the guy had a very popular, well-known, finance talk show on the radio in Edmonton. And this is supposedly a very reputable person because he has a large following. And the guy was like, this is a good investment. Everybody should just own this. Dump, a little over $1,000 a month into this thing and you won't regret it kind of thing. But there wasn't really like any kind of needs analysis. There was no actual planning involved. It was just simply a sales pitch to try to generate more commission by selling it. And that's by somebody who is like on the radio on a weekly or even maybe daily basis, but for sure weekly basis. And so it's just like, how do consumers, dissect and figure out who good advisors are from bad advisors?
Yeah. And again, like the challenge is like so many of the bad ones, all their time and energy and skill set is focused on sales. So they're really good at convincing people that they are going to do a good job, that they know what they're doing. And it's the exact opposite. It's like, I don't know. I've always thought it's the nerds you want. It's the people who are maybe not. I know personally, I can say I'm not the most personable person because I'm just like a math and logic focused person. Like I'm a nerd for lack of a better. That is the exact perfect description of me.
Yeah.
And that's why I know this stuff very well.
Yeah.
Yeah, it's a shame. I mean, any other you've told 2 insurance stories already.
Yeah,
And
I mean, because I have so many examples of insurance salespeople, we dealt with a client. This is literally yesterday that Nathan worked with. The person was paying $850 a month towards there's either a UL or a par policy. They're 70 years old, and their entire retirement income is about $4,000 a month. And 850 of that is going towards something to benefit the next generation and not even help them out in their own situation. And again, it's one of those things where it's like, why was that even recommended? And the client will say that, like, why did they recommend this? The advisor told me that I could draw this down and it would create this great income for me, but it doesn't, right? Like, yes, it can create a very tax-free retirement, sure, but I would rather have way more money and pay a little bit of tax on it than have, you know, massively less money and not be able to have anything to draw down on.
Yeah, well, and also most of this isn't really, it's not, a lot of it isn't for tax-free retirement. There's very few strategies that really accomplish that with the insurance. It's more a tax-free estate.
But a lot of people, I think, sell it as put this money into a par policy or a UL policy. All of your growth is tax free, which isn't technically correct because there is some taxation, within that. And then there's MTAR, the maximum taxable actuarial reserve, in terms of how much you can generate, within that. But ultimately, they're targeting people who are generally like anti-government, anti-tax, typically lower educated individuals who just like hate the idea of any taxation. They're like, what? This is all tax free? That sounds amazing. Let me buy as much of that as I possibly can. And they're letting the tax tail wag the dog, so to speak, right? So they're making their decisions based purely on emotion. And a lot of that is driven by the advisor's emotion in that sales pitch to sell them that policy.
Well, and I mean, I'll say a few things because, like, first off, I think no one wants to pay tax more than I guess your fair share, right? No one loves paying tax, but yeah, you are right. Like that is definitely one of the biggest sales pitches is don't pay tax. Whether or not that's actually true, and it's definitely never explained the pros and cons.
Yeah.
The other thing too, like just for viewers, and if any advisors are watching the podcast, like all the insurance stuff or everything we've talked about so far has been about insurance, and a lot of the stories will be about insurance. It's not to say like not every insurance advisor is a bad person. They're not all doing bad work, and it's not to say that no one ever needs insurance for anything. This is definitely not what we're saying. It's just particularly what I find is it's just the way the industry is set up, right? If you're only licensed to sell insurance, you're going to try to make everything about insurance. If you need investments, you need insurance. If you need estate planning, you need insurance. If you need retirement planning, you need insurance.
Yeah, when all you are is a hammer, everything becomes a nail, right? I've always liked that analogy, right? And so, you see this a lot with, because I get a lot of DMs from people, especially on like TikTok and a little bit on Instagram too, but like, oh, this guy from WFG or this guy from, like these multi-level marketing pyramid schemey, type environments where all they do is sell permanent insurance. That's like their product, right? Or the multi-level marketing system. But they're like, oh no, we have this great training. But it's the people who are training them and the people who are also taught just sell UL, right? Just sell par, right? Just sell a lot of insurance. And it's kind of this one size, fits all product that's great for absolutely everybody. And that's why, you see these advisors who get sued. You see these advisors who, are the regulator kind of cracks down on, or, licensing revoked and all this kind of stuff. Because of the fact that, like you say, they're insurance licensed. They're not actually investment licensed. They're not certified financial planners. They're not chartered investment managers, right? The barriers to entry in this industry are just so low that you can do a weekend warrior course and call yourself a financial advisor.
Yeah.
Right. And I know in Ontario, they tried to do title regulation and said, well, you have to meet certain minimums in order to call yourself a financial planner. But then what they did is they made the bare minimum to call yourself that so low that the same people can still call themselves financial planners. And it was kind of, counterintuitive, right?
Yeah, and I mean, like, shoot, you said something that I wanted to kind of touch on. Now I'm blanking.
No, it's okay. I'm just ranting right now because I'm frustrated because it really irks me when I see clients that are taken advantage of so strongly, and they don't know that there's recourse to go after, say, an advisor for that, or maybe there is no recourse to go after the advisor because they agreed to it and they signed off on it. Like, for example, with that one guy who sold a $50,000 a year policy, I said to the advisor, I said, why did you sell him this? And the guy said, well, he told me he said he wanted to own permanent insurance. I have never in my entire career had someone come to me and say, I really want to own permanent insurance. right? That's not something that people like seek out to buy. It's something that's sold, and it certainly has its place in a lot of, estate planning structures, especially for, retained earnings within corporations, and it's really tax efficient to pull out. But people don't actively come to people and say, I want to own permanent life insurance.
Actually, I had one time one client come and basically they specifically reached out for insurance, right?
Okay.
And we started doing more comprehensive planning as well. But in the process of that, they said, honestly, I really just hate the idea of like not like paying all these premiums and then just never getting anything out of it. I was like, fair enough, but genuinely, like, there's no part of me that can look at your situation, your goals, and tell you that a whole life policy or just some type of permanent policy makes sense. And I basically just like, and they kept challenging me. They were like, no, but we really want this. I'm like, and I basically what I said is like, look, I can tell you this, but I really don't want to. And it's not right. And I basically just kept telling them it wasn't right until they just decided not to become clients. And honestly, looking back, I feel so much better about that. Like, even though they were upset with me at the time, I really sincerely hope they didn't just go somewhere else and get a policy. That's probably what they did. But at least I can look back and be like, I made the right recommendation, made them mad, but at the end of the day, it's like it was gonna be so much more expensive. It was gonna be $5,000, $5,413 per year, per month in premiums for a client that should have been spending like a couple hundred on the same policy, on term policy for what they actually needed, right? For income replacement to retirement and mortgage
Yeah.
insurance, right? And yeah. But other than that, I've never heard of anyone be like, I want this, unless they've been fed some kind of
Or
sales
seen some
pitch.
video, like there was a period, I want to say it was like maybe 2022, early 2023. There was like UL policies were getting pushed hard on, the algorithm on TikTok or on Instagram and that. And there's so many people pushing it. And so we got a lot of phone calls during that period of like, hey, I saw the strategy. I really want to implement it. And then what I would do is I would walk people through it. And they'd be like, no, this can't be right because these returns are not good. And I'd be like, yeah, that's how it works. And they'd be like, no, but this guy told me it was all tax free. It was infinite, banking. And I was like, well, there's nothing infinite about it, nor is it banking. So like, yeah, that's what you were pitched. But when you actually break down the numbers, it's a really poor way to build wealth, right? It's a really great way to move wealth between generations for people who are super risk averse and don't understand investments. But that's a whole other piece about maybe you should just, educate your clients on how investments actually work. But where it works really effectively is when you have assets inside of a corporation that aren't going to get spent to avoid two of the three different types of taxes that will be paid in an estate on, corporate retained earnings or on a corporation that's in an estate effectively. That's where it makes a lot of sense. The problem is that it pays a lot of commissions. So that's where you see people, kind of pushing it. And then you get all the people on the videos that are overselling it, the benefits and the amount of money you can make from it. And that's when, fair enough, people do come to us, but then it's just like, all right, let's take a step back.
Yeah.
Let's actually look at the numbers rather than there's so many people out there who will just say, oh, great, this guy said he wanted to buy it. I'll sell it to you.
Yeah, exactly. And okay, taking it from the insurance piece for a sec, because another thing that popped in my head when you're talking about this, a piece of advice that I see all the time on TikTok, like real estate's become really big because if it all comes from this one chart pattern. If you look at from 2000 specifically until now, up until about 2021, actually real estate outperformed the stock market. A lot of stuff happened in the stock market over that time. Stock
Sure.
market's been below average return. Real estate's been above average return. But people take that and say, okay, real estate's a better investment. It's less risky, blah, blah, blah. There's so much misinformation about there. And one of the biggest strategies I see all the time that's pushed by people who make money off of like real estate investing is the idea that you can just get like, put 5% down on a home, okay, rent that out, and then leverage that home and put another, just basically mortgage that home to buy another home and then so on and so forth. It's like, that's not how lending works. You have 5% equity in one home. No bank is going to issue you any more funds than that, unless you're talking about like super predatory lenders, in which case you're paying like 12+% in interest. That's nothing. That's not a thing. And the amount of people, like my own brother was looking at doing this, and it's like I had to be like, walk him off the cliff, like, please, for the love of God, like whoever you're talking to is an absolute, they don't know what they're talking about. Don't do that.
Yeah.
But like, there's just so many, and it's always like clickbaity, like get rich quick advice.
Yeah. And I mean, it's even within our lifetimes, and like maybe not for everybody, but like 2008 is not that long ago.
Yeah.
And so many people lost their shirt by being over leveraged, into an asset class that dropped in value And then it just snowballs, right? You're underwater on one property, which makes the lender, call that loan, and then you're underwater and then underwater. And all of a sudden these property values are dropping. And you look at people that lost hundreds of millions of dollars, right? Or lost their entire, kind of like life savings because of being over leveraged into these strategies that are, kind of foolproof, right? And it's eventually it'll happen again. It might not happen anytime soon. But you saw that with people in Vancouver. You saw that with people in Toronto. Like we had a client that we took on that you and I both worked on recently. That they're down $400,000 on one of the properties that they bought into, and like kind of a recreational property, and they know they want to get out of it, but they're like, well, what do I do? Right? I'm going to lose money. I'm still going to owe money after I sell the property. So I might as well hang on to it, pay the mortgage and then hope that, because now I own a leveraged investment, right? Because I didn't put, 100% in, that it'll, increase faster, right? But you're underwater for maybe the next 5-10 years, right?
Yeah.
Who knows? Or for, who knows how long.
For anyone, it's also the sunk cost fallacy.
Correct.
But anyways, like, yeah, I mean, and one thing I was going to say too is you mentioned all of the advisors who get sued and otherwise disciplined, lose their licenses. Most of them don't. Right?
True.
Like most, really, what's the problem is that most of them get away with just giving terrible advice. It's just either way too generic. I read this, I think it was like from something in the basic licensing courses, so it's a bit loose in my memory. But there's something about like there's three types of advisors in the industry. There are ones that are incompetent but well-meaning, right? So they're highly ethical people. They do care about the people they work with. They're just not good at what they do. They don't have the knowledge. Or
Sure, they're new or, for various reasons. But yeah, well-intentioned, not educated. Sure.
And then you have the, highly educated or intelligent folks who are very unethical, and they're obviously dangerous in their own right because they can really take advantage of you. They can sell you something that is just so wrong for you, but it doesn't matter. It's going to make them money, and they can spin it to make it sound great.
Yeah.
And then, you have a relatively few people who are both competent and ethical. And it's really hard to find those ones. And so many times you'll find the people getting either incompetent or unethical advice, not enough so, or they don't know that they have recourse. And then down the road, it's no wonder why so many people hate advisors and hate the thought of paying for planning or investment management thing. It's like for the majority of people, they've gotten really bad advice. Like pretty much everyone you talk to, at least everyone I've kind of talked to at some point, unless they started with me. That sounds like I'm hyping myself up, but truthfully,
I'll hype you up.
but like so many people at some point have gotten bad advice, and if it hasn't turned them off of getting professional help in the first place, it's come very close.
And I think it's not just ours. I think most industries are in a similar way, right? In terms of like when they're, we've worked with lots of lawyers before. We've worked with some insanely competent lawyers, like incredibly intelligent individuals, and we've also come across, some not so ethical and, kind of competent lawyers. Same thing with accountants, right? I would say, fortunately, most of the accountants that we've worked with have all been, great, upstanding, fantastic people. But I have stories from clients from, accountants that weren't that great. So, I've heard the same thing with people who have gone to, therapists or psychologists or psychiatrists or, architects or designers or different things. I think there's a lot that plays into it. I can't speak for those industries, because I don't know them. But I can only say of what I've seen in our industry. And I would just say that I think part of the reason is because the barriers to entry are so low and people see that you can make potentially a lot of money. The problem is you're getting into this industry to make a lot of money. You're not going to be very successful because the people who are passionate about this industry, who become very competent at what they do, those are the people that clients are naturally, kind of attracted to. But unfortunately, there's a lot of people out there who, aren't competent, who still have the sales skills to try to, to kind of generate stuff, or people need to make money right off the bat. And so they're willing to do unethical things to just, put food on the table at the end of the day, especially early in their careers.
Yeah. And I was gonna say, I wholly disagree with what you just said about like how most of the people who are ultimately successful are the ones who are ethical and competent. I would say the vast majority, like especially like in this industry, like what I find is there's a good positive change. A lot of the younger folks coming in this industry they're coming with like an actual like finance degree or some type of like relevant degree.
Yeah.
They're coming with like a mindset of knowledge is the most important thing, like getting designations, like the CFPs quickly becoming the de facto industry standard. Like I think we
For me,
agree it
that's just
should
like
be,
the base level, right?
right?
It should be like the equivalent of passing the bar, right?
Right.
Like
Where it's
you
like,
can't even
yeah,
you can't even be or hold out as any kind of financial advisor unless you pass the CFP. Just like when you pass the bar as a lawyer, or you talk to any lawyer, they're like, well, the bar is like the base level. You learn everything that you need to know about practicing law from actually like working after you've passed the bar. But it's like an absolute base level kind of requirement versus for some people they view like the CFP as like the gold standard of like the highest level of, kind of accreditation and that. Whereas I see it as like, okay, you've met the basic requirements to be a competent planner.
yeah, yeah, exactly, and exactly right. And that's where honestly, like the investment industry, when you think of like Wolf of Wall Street, like that kind of era of like the early like 90s, early 2000s, that kind of
Yeah, the
era,
Wild West.
right? Like it's there wasn't really a whole lot of licensing, and that shows. And most of the people from that era they haven't gotten any more education since then. They've just rebranded themselves. They're not stockbrokers anymore. They're investment advisors or
Yeah.
financial advisors. And I would say, yeah, unfortunately, a lot of people have made a lot of money doing nothing particularly outstanding for their clients at best.
Yep. But I like that because I don't, obviously you're probably more in tune with younger people kind of getting into this industry, not by a long shot, but by a bit than me. And that's good. If you're saying that you're seeing more people who are coming in from like a standpoint of like a proper education and being like a consummate professional rather than just like a salesperson.
Yeah, like and it's great to see. I mean, it creates more competition, but I'm happy with that, right? If I lose a client, like a potential client, to someone that I know is also doing a good job, like they're also going to get them good investment returns and invest them properly. They're going to do good planning, right? To this day, a lot of advisors don't even do financial planning.
Yeah.
So if I know that like I lost a client to someone good, that's fine. I'm fine with that. As long as I know the client's going to get, good. But what really sucks is knowing you lost a client to someone who's going to hurt them, who's
Yep.
going to do an awful job. And 5 years later, the client's going to come back with like no money left to invest and say like, can you work with me now? And it's like, it just sucks. It just really sucks to know that in your heart. And, yeah, like I said, unfortunately, the biggest thing we compete with is the fact that, the kind of the other side, the advisors are really bad advisors, but really good salespeople. Well, they're just that. They're really good salespeople. It's hard to compete with.
Yeah.
And one of the worst
Fortunately,
things,
we don't run into that too often anymore. But
well, yeah, but it is. I'll say an interesting anecdote that I literally just watched this morning. But I was going to ask too, like, because something that's just not a good sales strategy just comes across really bad is like, how often do you come across a situation where you've seen a client just has gotten terrible advice and they're reaching out saying, hey, like I'm looking for a second opinion. And something feels off. On the one hand, you want to tell them like the truth. You want to say, yeah, whoever's been managing your stuff is an absolute like moron. Like they have no idea what they're doing.
yeah, we would never say that.
But exactly, it was the same. So like, how do you, I guess, get that point across? Or like, what do you do in those situations? Because you want to come across with the guy be like, yeah, everyone but me is an idiot, even if that is the case.
Yeah, I mean, I don't need to tell people because I can just show them, right? And when you take people through, the process, and you use the exact same process, more or less as I do, right? In terms of, kind of like, 3 meetings, building out a full comprehensive plan, like building out the structures to show people, okay, if you were to work with us, this is everything that we would actually be doing for you, making all those recommendations, showing them how in depth we're actually going with all this. And 99% of the time, their response is, "Oh wow, like I'm definitely not getting this from the person that I'm currently working with." So I don't have to say anything bad about anybody because, like, I think one of the worst things you can do to a prospective client so unhappy with their advisor is come in and start bashing that person. It just reflects poorly on everybody, right? It
Right.
reflects super poorly on you, right? Because that's the way you're going to win the case. No, I'd rather just listen. I can't change what's happened in the past. I can't, change anything that's gone on. So let me just show you, if you work with us, this is what that would look like. This is all the value that we'd be providing. And then if you want to work with us, great. And if you don't, that's okay too. Like I'm here to help the people who want help. And fortunately for us and our growth of our business is that there are so many clients out there who want good quality financial advice, who are happy to pay for it, happy to delegate, and they want that kind of relationship. So I know that if somebody says no to me at the end of the day, it's like, that's okay. I don't care. I'm not trying to force you to work with me because there are so many other people out there who value my services so strongly, and I'd rather put the time, into them. right? So like when there's a lot of people like, oh, it's not worth paying for financial advice, but great, don't work with them. Like it doesn't affect me. There are so many people out there who do want to work with a financial advisor. So I'll work with those people, right?
Yeah, and to be clear, like I'm not talking about like the ones who, well, I also doing it yourself, like investing, financial planning. It's so much more infinitely complex than people think it is. Day trading, for the record, is not a thing. It's nonsense. But what I'm thinking of is, when clients come and they're getting bad advice, because you hit it exactly in the head. You don't want to be the guy who's just bashing the other person, right? It doesn't reflect well on anyone. At the same time, like it's an ethical obligation, be like to tell someone like when they're getting screwed over, when they're
Sure.
getting bad advice, and it's like, yeah, like how do you do that? How do you draw the person's attention to the fact that they've been getting terrible advice and they're on a bad course without being the person saying, yeah, your other guy's an idiot. Just
Yeah. I remember we did a presentation for Crow Mackay. Oh, this is probably 8, 10 years ago. And one of the accountants there was, came up to us afterwards and said, hey, I think I've got a client who's getting taken advantage of by their advisors. And all right, well, we'll take a look at it. Client had about 10 million in assets. And what they were doing is they were in a wrap account. So they were paying like a 1% fee. Plus, they were putting them in A series mutual funds. So they were also making a cut there. And I can't remember exactly how it's structured. This is pre DSC ban. And you could also put a DSC somehow on like an A series fund. I don't know exactly how it worked, but effectively I know that's how it worked. What they were doing was they were reloading every so often. So they were getting their trailer, like an A series, kind of fund inside of a wrap account. They're already double dipping. And that's what they were doing is they were reloading constantly.
that's wild.
Every time, so that 10% DSC free, they were just reloading it, all of it with insides. They were making like 5, 6, 7% a year some years, right, on the client's investments. And when Nathan, explained this to the advisors that, yeah, this is kind of like what's going on, like, were you aware of that kind of thing? And just trying to be like, you newer and younger in the business at the time. And the advisor's like, yeah, but every time I call the guy, he sends me the money I need. He's like, okay, well, is that worth all the fees and getting completely screwed over? So that was an example of like, hey, you can lead a horse to water. But, and maybe we were just dumb because we were, newer into the business or whatever. We didn't know how to approach that one properly. But I think Nathan would have done a great job. And just, we were teaching at the university like we weren't idiots. And he explained it to the guy, but at the end of the day, he was just like, I just want somebody who's got discretionary management. We weren't discretionary at the time, which is, maybe that's where we missed out. But he's like, I just want to know that somebody's looking after it and trading on my behalf and can send me the money when I want it to be sent to me. And that's all he cared about.
That's wild.
It was brutal. We could not believe how much. And I think he was at Scotiabank or CIBC at the time. I can't remember which one. Again, I think some of the rules I know rules have changed in the industry. Like you can't put A series funds into like kind of a wrap account. Like you can't do anymore. DSCs are banned now as well, all for good reason. But like, yeah, that was a brutal one.
Yeah, I'm kind of I'm speechless. I don't even know what to say. I want to move on because that breaks my heart.
Yeah,
It's brutal.
and we didn't see that a ton, but we've seen that not just once. We've seen that
Yeah.
a few different times, especially with A series and wrap accounts, and it's just like,
The one that I came across personally, one of the big reasons I joined you guys instead of staying where I was, and I will say the firm, and it wasn't the firm itself, it was just the one person out of the firm that I was kind of training under, but their strategy was to put everyone into A series funds, mutual funds. For those who don't know, that's the one where you charge a front load fee, or like a sales commission up front, and then the advisor makes usually about 1% in the trailing commission. So like those are the mutual funds that have like 2.5% in fees, and about half of that goes to the advisor, the other half kind of goes to the mutual fund. So that out of the way, what this person would do is they would go into the A series funds, not charge the front end commission, just take the trailer fee,
front end zero,
right? And so basically, it was just a fee-based account. He was charging 1%, and the mutual fund charged the other whatever they charged. And the reason they did that instead of just opening a fee-based account with a 1% fee and using fee-based funds was so that the fees don't get reported on their statement.
Yeah,
because it's running through the mutual fund and then gets paid to him kind of basically behind closed doors, as opposed to having like a statement saying, here's exactly what you paid me for my services. And it's like, that's insane. And that was the out in the open logic and reasoning. Like, it wasn't like hush hush. It wasn't like I figured this out. It was like this was told to me specifically, as if like the person felt he was like teaching me something really cool and really like exciting. Like,
Yeah.
here's a way you can screw your clients. Basically, it's like, why is that
Or
the
yeah,
goal?
not even you're not even be screwing them. You're just not being transparent,
Yeah,
right?
fair.
Like it's just like, and what the funny thing is that if you use like a different series of that fund and charge a percent, the same percentage that you'd be making, usually the fee is actually lower, right? So you're more transparent. It's tax deductible in non-registered and corporate accounts. Like, and the client pays less, but you're exactly right. People want to hide behind that. And fortunately, there's been, updates to, to disclosure requirements. We just had the new update. I think it was just this year where we had, new breakdown on client statements where they're seeing it in dollar terms and different things where things are just more laid out for clients so that they actually know what they're getting and what they're paying. Because I think every client should know what they're paying and what they're getting in return for that.
Yeah, and yeah, I mean, so that was like one of the things that I came across.
Yeah.
Like, it all kind of harkens back. So this is the story that granted, I'm gonna preface this by saying this was a YouTube video. I did not fact check this at all. This could be a totally made up story, but it sounds true. It sounds right.
Sure.
But basically, like the story of like the most successful car salesman in history, and it was a person who actively went out of their way to like undersell. Right? If they have a client, if someone came in,
Yeah, I think I've seen the same one.
you know the one, and he's like, yeah, like I can save you $5,000. You said you don't need like you're not going very fast. You're not like racing your vehicle, so you don't need this engine. You're never going to use it. So I can save you $5,000 by just selling you this less expensive model of the same car. And the thing is probably for the first few years that person looked like a really moderately unsuccessful salesperson because they weren't selling the big ticket items. They weren't like making a ton of sales. Like if someone came in and they really didn't need a new vehicle, they were like, you don't need a new vehicle. We can just fix up your current one or whatever it was, right?
Sure.
And I don't know, it just really harkens. It sounds truthful because like over the long term, you earn that trust. You earn repeat business. You earn a reputation for being a good, ethical person. And it's like, yeah, that is the struggle of this industry, I think. It's one of them. There's a lot.
Sure.
Low barriers to entry also being probably the main one. But here's another struggle is, when you start in this industry, in most cases, in some way, you're usually like commission-based or fee-based pretty quickly,
Yeah.
right? And so, yeah, you have to feed yourself and your family. And usually the best way to make money in the short term is by lying and selling and cheating and doing unethical things at the very least. And for better or for worse, that's how you make money in the short term, or that's the way to make the most money in the short term in a lot of cases, right? Whereas, taking the discipline and be like, I'm going to focus less on sales right now and like go out and keep getting like more education. Like I'm going to get my CFP.
Yep.
That is, yeah, it's very obviously a long-term solution to get more business, getting a designation like your CFP. But most people take a look at them like, I don't have the time. I just need to get on the phone and start selling stuff.
Well, and a lot of firms, like the very first firm that I started with, they're like, why do you need designations? Like, why do you need a CFP? They're like,
Yep.
just go see people. I was like, well, yeah.
I was told to start selling insurance.
Yeah, I need the education, right, in order to like know how to explain things to people. And I remember having it out with my manager at the time. I have problems with authority apparently, but and just be like, okay, well, I was like, what am I presenting to them? And he's like, well, just build them a financial plan. I was like, what does a financial plan look like? Can you show me one? Like, and he's like, what am I supposed to build for people? And he's like, well, just talk to them about their investments and like sell them insurance. And I was like, but what is this plan that I'm supposed to present to them, right? And like nobody can actually show me there. And then so I went outside the firm and I went online and researched that stuff, and we've built kind of our own systems, kind of as a result of that. But I think it all kind of stems from, what you're taught in this industry because it is so sales driven and, quota driven that, people aren't taught. Go spend spend most of your time getting your CFP CIM, first year. And then after that, start, at least you have a good base from an investment standpoint, and a planning standpoint that's done. And then you can start to do things, like, additional designations, whether you want to do your TEP, right? Whether you want to do, CIWM or like CLU or some of these other, accreditations. And then kind of get more specialized.
Specialized, yeah.
Yeah. But absolutely bare minimum CFP, CIM right off the bat. Just get those done. And then you have the education.
Yeah. And I mean, yeah, like, and then if you go with a big firm, you're usually going to face kind of quotas like that, like sales quotas. And it's like the people who are selling a lot who are probably not doing a great job for the clients, who are getting like recognized and getting awards and stuff, getting on top advisor lists and stuff like that. Whereas, yeah, if you take the time to do designations, that's probably the big one, right? This is if you don't have education, if you don't have knowledge, what are you using to advise people? What are you
Totally.
drawing on to advise, right? But yeah, like the other thing is if you have if you go independent, right? Then you get away from the quotas and stuff and like the in-house products and all that, but then you're like truly on your own.
Yeah.
So it's hard to get started. And I want to say that a lot of people get in this industry because they genuinely want to help people and help their clients and stuff. I think maybe just the way you get paid and just the way the first few years go probably turns a lot of people to just being like, ah, screw it, I just want to make money. But I don't know. It's for one reason or another. There's a lot of unethical people in the industry or incompetent.
Yep.
It's hard to find the people who are both, who are good in both ways, right? Ethical and competent, and yeah.
Totally. Unfortunately, I don't think we can solve all the industry's problems, but yeah, I wanted to come on today and just rant because I was angry after today, and we almost didn't film today because I was frustrated. But I'm glad we did. We came in, we got some good stuff. Hopefully, to anyone who's listening, thank you for letting me rant at you today.
Is there any last story you want to tell? And what's like the worst thing you've ever seen?
The worst thing I've ever seen. Yeah, one advisor who he was selling products he wasn't licensed to sell off book OM securities, right? That he wasn't licensed to sell high risk stuff, and people's retirements, everything went 100% to zero because it was a product. It wasn't even like, oh, I made a bad recommendation. He's like, no, you weren't legally allowed to sell that. And so what you did is you went behind your dealer's back, even though you were one of the founders of that dealer, sold that. The clients lost everything. And sorry, just wash your hands of that.
Yeah.
Yeah.
It's bad.
That was a bad one.
That's
And I saw that
bad
to multiple times. This advisor had done that. I also, when I was at London, I took over a kind of a block of business to somebody, and I can't remember the name of the guy now, but he was running some Ponzi scheme and he ended up in jail, and I think he's still in jail. But there was like 100 people in this block of business that like were his clients. And I think there was a bunch of different class action lawsuits and stuff that went on at that insurer, kind of over the years, especially back in the 90s. But I just remember specifically some people like, oh, you might have heard the news about so-and-so advisor. Oh, yeah, he was actually our advisor, and we lost a ton of money. I can't remember his name off the top of my head. Nathan might remember, but yeah, I would say that was almost the worst one. Was probably the guy who was selling stuff he wasn't licensed to sell to people that weren't really qualified for it, and doing it behind his dealer's back, and never got caught, walked away scot-free.
And it's not like they were selling GICs. It was like the highest risk stuff.
The highest risk, type
Most
securities.
complex.
Most complex, lockup periods, no liquidity. Yeah.
Yeah. Rough.
Yep. Anyway, I'll call this episode The Downside. All right. Well, thanks for joining me today. Thanks for listening to me rant. Till next time.